A steep fall in inflation has reduced the chances of another Reserve Bank rate increase next week.
After 2023, which has been a financially challenging year, many Australians are understandably questioning how the long elevated interest rates will persist and when they might see some easing through rate reductions. As interest rates hover at unprecedented heights, the nation finds itself at a crossroads, navigating the complexities of monetary policy and its impact on everyday life. So, let's take a look at the most important factors that will affect Australia's financial future, from the Reserve Bank's strict monetary tightening to the unpredictability of the world economy. With views from top economists and a close look at the newest economic indicators, this video gives a clear picture of what the future holds for Australia. In recent weeks, it's become evident that the Reserve Bank's 18-month campaign of monetary tightening has taken its toll. Starting at a historic low of 0.1%, the cash rate climbed to 4.35% by December, affecting both consumers and businesses. December's data revealed a significant drop in Australia's business confidence to its lowest in 11 years, while consumer outlook remains bleak, primarily due to increased borrowing costs and high prices. This strain was also visible in the Australian economy's unexpected slowdown in the September quarter, with the gross domestic product, GDP, growing a mere 0.2%. The usually robust property market has slowed down too, as declining affordability sidelines potential buyers. But what's the reason for these soaring interest rates? The Reserve Bank points to Australia's persistent high inflation as the key driver behind its consistent rate hikes, which risk pushing the economy into a recession. So, December 2022 saw the Consumer Price Index, CPI, peak at 7.8%. And despite numerous rate increases by the central bank, inflation has been sluggish to decline, remaining higher than anticipated at 5.4% in the September quarter. It's still far from the Reserve Bank's inflation target of 2% to 3%. And following this, the central bank resumed its rate hikes in November after pausing for 4 months, raising the cash rate to a 12-year peak of 4.35%. Globally, banks like the RBA's are cautious of inflation becoming a fixed expectation, potentially necessitating even higher interest rates and unemployment to curb it. High inflation disrupts the economy by leading people to delay economic activities, to shield themselves from its impacts, wasting economic resources. It can also negatively impact productivity, devalue savings, strain household budgets, and complicate business planning and investment. So, will interest rates climb further? Could they go even higher? Before we move ahead on that, I'd like you to take a moment out of your time and subscribe to our channel if you like our content. For new videos and updates, you can always choose to get notified as well. Now, most economists, including the RBA, are uncertain whether the interest rates will continue to climb further. They believe future economic data and emerging risks will determine the answer. But we can get a pretty good idea of the future with the data we have now. Callum Pickering, an Asia-Pacific economist at Indeed, suggests more rate increases are possible depending on the signs of moderation in service sector inflation. Service sector includes services like housing, transport, restaurants, travel, and etc. This will likely hinge on the inflation data for the December quarter, due at January's end. This means recent indicators, monthly inflation, labor market, and GDP data imply that monetary policy is starting to impact the Australian economy. The reduction in household spending indicates a lesser likelihood of another rate hike. ANZ Bank senior economist Adelaide Timbrell shares a similar perspective. She believes that while another rate increase remains a possibility, recent data, including November's higher unemployment rate, makes it less probable. Timbrell also suggests that the Reserve Bank might be finished with the rate hikes for now. However, if inflation unexpectedly exceeds the RBA's projections, or if there's a growing risk that inflation won't meet the target by the end of 2025, the Reserve Bank might consider another rate increase. Regarding this, the RBA Governor, Michelle Bullock, recently admitted that 2023 has been a tough year for Australians dealing with the rising interest rates and inflation. Unfortunately, the central bank's 13 rate hikes since May 2022 have led some households into mortgage stress. Overall consumer spending has risen just 0.4% in the past year and is down 2% per capita. Households have only maintained spending by reducing their savings rate, compensating for a drop in household income. With the present cash rate, Australian households face a challenging year in 2024, where household spending poses the greatest risk to the economy. According to Timbrell, the situation might worsen in the short term before stabilizing. He further mentioned that the economy is likely to slow down in the first half of 2024, followed by a recovery. Particularly, household consumption is expected to decrease shortly before rebounding, as reduced inflation and the cessation of rate hikes improve real household incomes. So, when can we expect a reduction in interest rates? Although another rate increase is being discussed, some analysts are already considering the likelihood of rate reductions next year. Callum Pickering suggests this debate will center on declining household spending, but clear proof of inflation returning to the 2 to 3% target range is needed for the RBA to be persuaded. It's important to understand that for rate cuts to happen, inflation will need to fall short of expectations, or there needs to be a perception of a dire economic outlook. So, it can be argued that the household sector poses a significant risk to the economy and could spark more talks about rate reductions in the latter half of next year. Similarly, ANZ's Timbrell points out that for the Reserve Bank to contemplate rate cuts, it would require clear signs of inflation slowing down and sufficient cooling in the labour market. He explains this would mean higher unemployment and lower inflation, indicating enough economic cooling to warrant easing monetary policy. And interestingly, the US Federal Reserve indicated last week a halt to its monetary tightening, hinting at reduced borrowing costs in 2024. However, economists doubt this shift will compel Australia's central bank to follow suit with rate cuts. So, while the RBA pays attention to global trends, decisions to cut rates will primarily depend on the domestic factors. Simply normalizing monetary policy internationally won't necessarily influence the RBA's stance, which could actually benefit for such a move due to its effect on the Australian dollar. Timbrell seems to hold a similar view, suggesting the Fed's potential easing might aid the Reserve Bank in commencing rate cuts by late 2024. However, domestic factors will have a more substantial impact on Australia's interest rate path. He emphasises that Australian inflation and related issues are largely homegrown, focusing on wage growth, the Australian labour market, household spending, financial stability, and domestic inflation. AMP's Shane Oliver also thinks that Australia's inflation and interest rate trends, which initially trailed behind the US, will similarly follow on the decline. The US shift towards rate cuts suggests that the RBA will likely do the same, albeit with a delay. When interest rates eventually decrease, economists believe the fall will be steady and not as low as before May 2022. However, opinions vary on the extent of potential rate cuts next year. So, we can anticipate more discussions about easing in the second half of next year as households continue to face difficulties. It would still be wise to not act against expecting rate cuts next year, unless household sector conditions worsen to the point of risking a recession. Timbrell here predicts that rates will mostly stay at the current 4.35% throughout 2024, with a possible 25 basis points cut in the fourth quarter. Meanwhile, Oliver from AMP is more optimistic, foreseeing the RBA beginning to lower rates by mid-next year, aiming for a cash rate of 3.6% by the end of 2024. Economists seem to be watching really closely, as each new piece of data adds a stroke to this evolving economic landscape. The decisions made by the RBA in the coming months will not just be a response to current conditions, but will also shape Australia's economic trajectory for years to come. For similar content, don't forget to check out some of the other videos on your screen.